Thank you all for being here. Every year, Americans underpay their taxes by about 15%. In 2019, that equates to about $550 billion. Put that in some context, that was more than the gross revenue of Walmart, Amazon, Apple, or ExxonMobil. More than the entire GDP of Sweden, Thailand, Argentina, or New Zealand. And over the next decade, the tax gap is likely to be larger than every dollar we spend on Medicaid and the Affordable Care Act, and more than everything we collect from all corporations, estates, excise taxes, and tariffs combined. In other words, it's massive. We all agree that people should pay the taxes they owe, but what measures should we take to enforce those taxes? And how do we know if we've gone too far or not far enough? I'm really excited to be joined today by Natasha Sarin, who's the Deputy Assistant Secretary for Economic Policy at the Department of Treasury, to discuss these and other questions. Sarin is a key member of what I think has been referred to as the administration's tax compliance brain trust. Prior to work in the administration, she was a law and finance professor at the University of Pennsylvania and holds both a JD and PhD at some party school called Harvard. She's also written a number of articles with Larry Summers and others on tax compliance issues, and we're very excited to have her. So Natasha, thanks so much for being here and for joining us today. I'm going to start by asking Natasha a few questions, and then I'm hoping that our audience will as well. So please do use that Q&A to put your questions in there, and we'll try to get to them as best we can. Let's start with something sort of basic. Every president, going back at least to Ronald Reagan, has put forward measures to reduce the tax gap, every single one. But this administration seems to have made it more of a central priority. It's one of the first things you released coming out of the gate for the American Families Plan, for example. Why is improving tax compliance so important in general and for this administration?
So first of all, thanks, Mark, for having me, and thanks to all of you for being here this afternoon. I mean, Mark's statistics kind of explain why dealing with tax compliance in a meaningful way is a central focus of our tax agenda here in the Biden administration. But let me do a couple of other pieces here. The tax gap is going to total, left unaddressed, $7 trillion over the course of the next 10 years. That's equal to all of the individual income taxes that are paid by the lowest 90% of taxpayers in this country. That's about 3% of GDP on an annualized basis. This non-compliance isn't just so significant in magnitude that the revenue raising potential of making meaningful strides is quite large, though of course it is. It's also not evenly distributed in the economy. So while roughly 99% of taxes that are owed on wage income are paid to the IRS each year because your taxes are withheld from your wages, those who accrue income in opaque ways, who are disproportionately at the top of the distribution, underpay their taxes by on average 55% each year, such that the top 1% is responsible for $160 billion in unpaid taxes annually. That's over $2 trillion over the course of the next decade. So it's not just that you can raise a lot of revenue from the sorts of measures that we're pursuing in the administration presently. It's also that you can raise a lot of revenue in a hugely progressive way. And it's, in some sense, I find that the revenue raising potential, which is like our proposals are going to raise $700 billion over the course of the first decade. It's more than twice that, and we can talk about why that is, because these investments are very significantly, they have high fixed costs, and so they pay off very significantly in the second decade. They raise around 1.6 trillion. The revenue raising potential is almost second order relative to sort of the equity and fairness aspects here that I think can't be stressed enough, which are, if you're an American worker in this country, you are paying all that you owe to the government. If you are a person who accrues income in opaque ways and are at the top of the distribution, you are not. And first order, before you get to other very important tax reform sort of efforts that are underway in this administration, seems kind of obvious that as a matter of fairness and as a matter of revenue, you really focus on compliance and meaningful sort of space by which you can make significant progress. And that's what we're doing. And sort of we're doing this in two ways, both of which are immensely important. One way is giving the IRS the resources that it needs to really pursue evasion and make a meaningful overhaul of tax administration in this country. Today, the IRS has fewer revenue agents than it had since any time since World War II. It's also running on 1960s technology in meaningful ways. You can't have a tax system that is able to keep pace with the challenges of this economy that runs on COBOL. You just can't. And giving the IRS the resources that it needs to retool significantly is going to make meaningful progress, not just in enforcement, but also in areas that are hugely important, like taxpayer services, where you'll finally have an IRS that can answer the phone when taxpayers have questions about their tax filings, and that can help taxpayers make sure they have access to the credits and benefits to which they're entitled. But when you have a $7 trillion tax gap, and I know we're going to spend a fair bit of time on this today, Mark, when you have a $7 trillion tax gap and 15% of taxes that are owed or uncollected, and tax compliance rates on certain forms of income are under 50%, you can't audit your way out of that sort of compliance problem. And so what you really need, alongside a significant investment in the IRS, is you need to give the IRS access to information that it can use to better understand how to deploy its enforcement resources, such that taxpayers who know that this information exists are going to be encouraged to be more honest with respect to their tax returns. And so a really important part of this proposal that's gotten a fair deal of attention, especially of late, is the idea that there's going to be an information reporting regime that builds off of the existing information that banks already provide to taxpayers and to the IRS about the interest income that accumulates in their accounts. We're going to add a little bit of information to this pre-existing form, and that little bit of information is going to make it such that we know for a subset of taxpayers, total money that comes into their account and total money that goes out of their account. And we can use this information to better deploy enforcement resources where they belong, on the high end, where you actually have evasion, rather than on regular American workers where you just don't.
Let's actually dig into the information reporting policy a bit more, because I know you got some criticisms and concerns early on that we don't want people monitoring every single transaction and knowing, that I gave money to Dave for poker last night or to reimburse for paying for dinner. The administration, I think, in part in response to these critiques, came out with an updated version. You came with an updated version of your policy that differs from what's in the budget. What kind of updates did you make, and what challenges did they address?
So I want to sort of speak to your question in many parts, and to start kind of up top with the reality of what this proposal has encountered, which is a real false narrative from lobbying groups and a few wealthy families that has tried to paint this information reporting regime as something that it isn't, and never was, and never intended to be. There was never any plan. The administration's proposal was never, the Green Book proposal was not. The idea that whether Mark, went to poker and spent some money at poker, or decided to buy new furniture, these sort of transactions that he's making in his bank account were never the focus of any information reporting or any collection that was intended to be part of this regime. Painting a sort of false picture of what this proposal was an attempt to derail the idea of any information reporting on these opaque income streams, and an attempt to derail that's not all that surprising when you think about the significant dollars at stake here, right? You have people who are underpaying their taxes or non-filing entirely, not paying any of the taxes that they owe, and who profit to the tune of $200 billion annually if you're in the top 1% from that non-payment. So there's a lot of money at stake, and so the misinformation has been really quite extreme. What the proposal always intended to be was providing a lens, a way for the IRS to glean whether certain types of taxpayers who accrue income in these opaque ways are actually complying with their tax obligations. And the way you get that lens is by reporting on aggregate total dollars into an account and out of an account on an existing information reporting ecosystem that already exists between banks and the IRS and taxpayers. We've the entire focus of these efforts from the get-go, and kind of the reason why I characterize this proposal and these set of efforts as really about fairness and about appropriately targeting resources and information on wealthy tax evaders and limiting their ability to continue to evade the obligations that they have to our government, is in some sense to explain to you what, from like a values perspective, these set of initiatives have really always been about. And this reporting regime has been characterized as meaning that there's going to be an IRS agent in every bank account or an IRS agent on every doorstep. And that simply was never the intent of the proposal and was never the intent of these efforts. What Chair Wyden has sort of very helpfully done with respect to the administration's Green Book proposal in this space was add features to the initial proposal that make clear that that is the focus, and that narrow and tailor the proposal to be very precisely about the kind of taxpayers who we always intended it to be about, which is wealthy tax cheats. The ways in which we've done that, or the ways in which he's done that, is that the threshold before which you are part of this reporting regime has been raised by an order of magnitude to $10,000. Additionally, there's totally carved out of the regime altogether. No additional information will be reported on taxpayers who are wage earners, who are already fully compliant with their tax obligations, those who receive federal benefits where compliance rates are 95% and above. And that means that the additive information from this information reporting scheme is really precisely on those opaque income streams where currently no information exists. And I think targeting in that manner and clarifying in that manner is actually a meaningful step forward for the proposal. Another thing I'll say, that just to further indicate exactly where and what we're focused on here, as part of this set of initiatives, it is very clear, it's explicated, in fact, in the president's proposal and also in sort of legislative considerations on these dimensions, that audit rates are not going to rise relative to recent years for anyone who's under $400,000 in income. So this sort of fear mongering that you've seen, that this is IRS agent on every doorstep, is just totally out of whack with what the proposal actually is, which is a little bit of aggregated information once a year about a certain subset of accounts that are disproportionately high earners who are not wage earners, and using that information to target enforcement activity better, such that compliant taxpayers aren't audited, because why do they need to be? And the IRS can focus its resources where they belong, on those who are actually evading.
Just one clarifying question. Is that $10,000 the account balance or the total amount of transactions in a given year?
It's total dollars flowing into the account and total dollars flowing out of the account. So the $10,000 isn't an account balance threshold, it's just total money coming in above and beyond wages, above and beyond federal benefits into bank accounts.
So I'd have to be reimbursed for $10,000 worth of dinners in my account before they were looking at me.
That is exactly right.
So let's move on to, we are getting some questions about this particular proposal that I want to dig into. But let's move on to the other, I think, signature part of the administration's tax gap proposal, as well as the House's proposal. And I haven't seen Chairman Wyden's, but I'm assuming it'll be in there as well, which is that you all proposed to fund the IRS additional $80 billion over a decade, $8 billion a year. Last year, the IRS budget was already, including the COVID money, about $15 billion, which is the highest it's ever been. Why do you think we need a 50% boost? And I think more when fully phased in the IRS's budget.
Yeah. So a couple of things to point out that are perhaps important perspective to have. One is that the IRS's budget has been gutted over the course of the last decade. It's down in real terms by 20%. It is down, its workforce is down by 20%. That workforce decline is actually especially concentrated in complex revenue agents, those who are capable or who are trained to spend hundreds of hours peeling back complex partnerships or engaging with global high net worth types of returns, which take significant time to really try to understand whether tax obligations are being appropriately fulfilled. The IRS's resources presently are so sort of the IRS resource constraints are so pronounced that today the IRS receives around 4.2 million partnership returns each year. It begins audits each year of about 7,500 of them. So you are in a world in which, from an enforcement perspective, the IRS just simply does not have the tools that it needs to be able to make meaningful strides with respect to compliance. It also doesn't have the tools that it needs. Again, if you're running on 1960s technology and trying to create systems where you can do complex machine learning or data analysis of the same taxpayer over time to understand whether there are discrepancies in tax returns, or similarly situated taxpayers to try and see whether people are appropriately paying what they owe. None of those capacities exist presently at the IRS because you have siloed systems that don't talk to each other, that are kind of iteratively building on one another in ways that are really difficult to maintain and really problematic from a sort of stability of the IRS perspective. There's also really, and like everyone who's spending their afternoon sort of thinking about tax compliance is well aware, and thinking about tax administration is well aware of like the true service deficiencies that exist at the IRS presently that are also a function of resource constraints. The reason that no one answers the phone at the IRS is not because the IRS doesn't want to answer the phone. It is because the IRS today does not have the resources it needs or the manpower that it needs to be able to assist taxpayers when they have questions. And that actually has, it's not, and we can talk about revenue effects and things, but that actually has a conceptually and in reality important impact on compliance, because it both sort of is important from a taxpayer morale and trust in tax administration perspective, and you are getting your questions answered about your tax filing so you file more accurately perspective. So all of that is like really quite sizable and quite important. And the way we arrived at this $80 billion number and where it came from is spending months with the IRS trying to understand what their needs are and what they could reasonably deploy and on what cadence. And so the way that this funding is sort of conceived of is that the IRS is going to grow manageably in each year. It's going to grow by around 10% a year over the course of the next decade. The fact that there's a mandatory funding stream that's in place for a decade means that the IRS is going to have, for the first time in its history of recent, is going to have the security that it needs to be able to make investments that have incredibly high fixed costs. It takes years for a revenue agent to be fully productive. It takes years to be able to retire the individual master file, the 1960s master file that is currently at the IRS. To retire it is going to take 8 years. So these are not changes that are going to happen overnight, and having the security in place and the stability in place to be able to make those kinds of investments is going to be hugely meaningful for the IRS. And it's going to be transformational. This is like a once in a generation opportunity to make the kind of progress for tax administration that the IRS so desperately needs. Those resources will enable the IRS to better use the information that it already collects. It will also provide the IRS the funding that it needs to be able to deploy the information that it's going to collect through information reporting regimes like the financial reporting regime that we've designed.
So I'm going to pull in a few audience questions here because I'm getting a couple of the same ones over and over again. I think would be helpful. The one is that folks are interested to understand what you mean by opaque sources of income. What kind of income are you talking about? And the other is people want to know, how much does lifting that threshold to $10,000 and excluding the wage and government deposits, how much does that shrink the number of accounts, do you think? Like sort of, were we talking about 80% and now we're talking about 5%, or what's going on there?
Yep. So let me speak to both of those pieces in turn. When you're talking about opaque income, I wish I had my fun chart here, Mark, but when you're talking about opaque income streams, what you're talking about is proprietorship income, partnership income, income streams where there isn't currently sort of true third-party reporting to the IRS. In contrast, when you think about wage income, or when you think about pensions, or when you think about federal benefits, unemployment benefits, there is already information sharing that exists such that both the taxpayer and the IRS have a sort of accurate understanding of what your actual income is in those particular streams. And that both means that you report honestly because you know that the IRS has this information, and that if you don't report honestly, the IRS knows that they should pursue you because there's a discrepancy between the sort of information reporting and what you report on your tax return. The second question about like, what does this do to the universe is an important one. And so the way that I have been, and it's a one that people on this call will not be surprised to know is like non-trivially difficult to answer, but let me try to give you a version. It turns out that about 82% of Americans have their wage income reported onto the IRS through W-2. About 19% of Americans receive Social Security benefits that are reported onto the IRS. It also turns out that, and this is not really the right statistic, but it is roughly a statistic, the average account balance in the US is something like $2,000. So when you're thinking about trying to understand what the universe of people is that you're capturing here, I think the nature of the tailoring is such that you're kicking out of the regime the vast majority of wage earners, and that's close to 80% of the population that's going to be exempted from this regime. The exact specifics we're going to kind of see in distributional information on types of accounts and the types of income that accrues in different types of accounts is not really all that easy to get a handle on, but that's how I think about the nature of the tailoring that's occurred.
I guess the irony is if we had the information reporting, we would know how much less information we were getting, right?
That is exactly right.
It sounds like what you're saying is that the wage exemption is doing more of the heavy lifting than going from 600 to 10,000.
I think they're both doing a fair amount, but the wage exemption is definitely doing a very, very significant amount just because of the volume of wage earners in this country.
Let's talk a bit about privacy. I know there's been some concern about obviously privacy in the bank accounts, but also leaks or cyber attacks on the IRS itself. What can we do to kind of secure the IRS and to give critics and Americans confidence that their tax information isn't going to be leaked or stolen by cyber criminals or otherwise made public?
It's interesting, and I also think ironic that you've seen some of the advocacy groups push against this proposal, the compliance initiatives that the administration is advocating, by saying that the IRS doesn't have the capacity to be able to protect taxpayer data in a meaningful way. The reality is that, as you've sort of pointed to already, the IRS experiences 1.4 billion cyber attacks each year. It is remarkable that it is able to protect taxpayer data when it is experiencing that volume of attack and running on 1960s technological infrastructure. So if anything, concerns about taxpayer privacy, which I take very seriously and I think are deeply important, they push very strongly in the direction of adopting these sets of proposals that we've advocated. Because what exists in this $80 billion of funding is resources that are directly focused on not just modernizing the IRS's antiquated technological systems, but also providing the IRS the tools that it needs to actually be able to meet the challenges of the economy in which we exist today, which are just fundamentally not present at the agency currently. So I feel like the taxpayer privacy concerns are totally legitimate, and they encourage us to make meaningful progress on technological modernization and giving the IRS the tools that it needs to meet the threats of the day. I think that the sort of a piece that's like really cannot be stressed enough is that it is imperative to empower the IRS to be able to protect against any sort of data security threats that exist. It is also imperative as a matter, and the resources to do that and the planning and the thought about what that will entail and what is already happening at the IRS and what has happened and what will continue to happen on these dimensions is really quite significant. The idea that providing the IRS with the resources and the information it needs to make meaningful progress on a tax gap that accrues disproportionately to the very wealthy isn't something that we should pursue because of concerns that we won't be able to deploy these resources in the way that's most meaningful from a privacy or security perspective is silliness. We, of course, will be able to, and all we need is the capacity to do so, and that's exactly what this proposal provides for.
So we have a couple more questions for the audience on that $10,000 threshold. One is asking why not lift it to say $100,000 if you're really just focused on the very high earners. The other, I think, was more of a suggestion, which is have you considered linking it to the gift tax threshold so that you're not kind of, which I can't remember if that's 15,000 or 16,000, but somewhere in that in that range.
That's it. So both very good questions, and maybe I'll take them in turn, or actually take them kind of together because they're about like why the threshold and what's the number. It is a little bit, I understand that from like a messaging perspective as I speak to the proposal, it can sometimes sound a little discordant to be talking about, you're talking about top 1% tax evasion, you're talking about going after the very wealthy. On the other hand, you're talking about account flow thresholds of $600 or $10,000. So what is the relationship between those two things, right? And I think that the piece that sometimes gets lost in all of this is when we are talking about increasing enforcement scrutiny or increasing tax collection from the very wealthy as a result of these, or high earners as a result of these initiatives, the reality is that currently those high earners are profiting very substantially from a tax system that allows them to basically play by the honor system, whereas for American workers, you're fully compliant because you have to be in a meaningful way. As you start to raise thresholds for this type of reporting very significantly, so let's take an extreme example that you raised a threshold to $1 million before you collected these 2 boxes on your 1099 int. In that case, the very wealthy and the very high income who are profiting from evasion presently, if I wanted to do $2 million of evasion, it would be pretty straightforward for me to just open up 2 accounts and have them both under $1 million of flows each year and not be reported on to the IRS because it's not under whatever the reporting threshold is for this new regime. It's true that, you know, there's a lot of numbers between 600 and 1 million, but as you start to get to thresholds that are higher and higher, you create huge incentives for the very top who have at their disposal a lot of resources, as we are watching, as we see this sort of intense lobbying effort, to just structure. And their third-party providers will pop up, as exists in the deposit insurance landscape, to just structure accounts and keep them under whatever the threshold is and just continue your evasion writ large. And so I think that trying to come up with ways, I think the value of what Chair Wyden has really done in this space is he's been incredibly thoughtful about coming up with ways to exempt the type of taxpayers who are already compliant and for whom this information isn't actually all that relevant because we already know their income. It's on a W-2, like you don't need to know anything. In this particular context, they're not accruing income in opaque ways. And then think a little bit about the ways in which you can still capture information on high earners who accrue income in opaque ways, who might be structuring accounts to stay under whatever the set of reporting thresholds that are considered. And I think there is, the gift tax point is well taken. I think there is value in trying to think about what the right number is here. I think Chair Wyden spent a lot of time arriving at this proposal, and I think there's use in thinking through some of these suggestions as well.
We spent a lot of time talking about tax compliance among the top 1% mainly, but the third largest source of the tax gap is actually the EITC, right? Tax credits, according to IRS data, have a misreporting rate of something like 40%. I've seen other numbers that are more like 25%, but still pretty significant compared to the 1% for wages, and probably going to be more significant, assuming that we do expand tax credits and build back better. Would the administration's plan do anything to address improper payments among tax credits? And if not, why not?
So a couple of pieces there. And before I talk about improper payments, I'm glad you talked about the EITC because you're going to laugh, but I'm going to tell you about why this is important from the sort of high-end evasion perspective. So what's happened over the course of the last decade as the IRS has been gutted is that its resources to do the top stuff have just been totally destroyed, right? So complex revenue agents are down like 40%. About half of that workforce is eligible for retirement in the next year. So the result has been there's been a disproportionate drop-off in audit scrutiny at the top of the distribution. those EITC audit rates have actually been quite stable. In part, they've dropped, but not nearly as significantly, such that you're now as likely to be audited if you're in the top 1% as if you are on the EITC. And the top 10 counties with the highest audit rates in the country presently are low-income minority communities in the South. So like, as a matter of equity and fairness and share of the tax gap sort of types of questions, it strikes me that where the focus needs to be and where the focus of this proposal certainly is on the top of the distribution where resources have dropped off, where enforcement scrutiny has dropped off, and where you just don't have the capacity to do the kind of complicated field examinations that are required in that space. I think the point that you're raising, which is an important one, is that what sort of, you keep talking about high-end evasion and that being the focus, what kind of guardrails exist in the compliance proposal to illustrate that that isn't exactly where additional resources and additional information is going to be deployed. And to that, like, there is explicitly in the text, there does say that audit rates are not going to rise relative to recent years for those who are under 400K. And I think just as a matter of fairness and as a matter of tax equity, that is an incredibly important commitment from this administration, which is that this is really about, this is not about regular sort of American workers who are already complying with their tax obligations. It is really, and it's really, really about wealthy tax evaders who are simply not paying their fair share presently.
We have a few more audience questions I want to pull in. One wants to understand what's the difference between tax evasion and tax avoidance. The other sort of builds a little more on what we were discussing before, which is how much of the tax gap is really the underground economy, you know, illegal drugs and other things like that, and is that really being driven by the top 1%?
So let me do the second one first, and then you might have to remind me the first question. But so what part of the tax gap is the underground economy is an incredibly important question, and it turns out a very unsurprising to you who asked a very difficult question to answer, because quantifying the nature of tax evasion is actually incredibly challenging, and the nature of certain kinds of tax evasion is really quite difficult. The way we arrive at this like $600 billion number is you take an official IRS tax gap estimate, that the most recent of which, by the way, exists for years 2011 to 2013, which another part of this proposal that we can talk about, you know, where every dollar of the 80 billion is going, but another part of this proposal is giving the IRS research team the tools that it needs to be able to invest in providing more real-time tax gap estimates. And that's important both to paint a picture of what evasion looks like. It's also important to reflect the sort of progress that we're making on efforts that we're going to be undertaking with these new resources and this new information. But the way that the tax gap is estimated is you do random audits, essentially, of taxpayers, and you look at the differences between what they report on their tax return and their post-audit income. You make adjustments for the fact that not all auditors are created equal and some are higher skilled than others, and you arrive at a tax gap estimate. And that tax gap estimate for the most recent years, sort of extrapolated for growth, is about $600 billion. Their Commissioner Rettig has sort of spoken to and testified about the size of the tax gap and has pointed out that he thinks that $600 billion number is a lower bound precisely because it misses out in important ways aspects of evasion that are actually really difficult to get a hold of even when you audit someone. So things like crypto evasion, things like offshore evasion, things like evasion structures in really complex partnerships that are just hard to even unpack in an audit. And those sorts of, if you think about those sorts of income streams or those sorts of unpaid taxes back into the tax gap, he thinks that the number is more like $1 trillion annually, which means that, by the way, the decade number is more like $12 trillion annually rather than my 7. I think what the distribution of that additional unpaid taxes is actually incredibly hard to quantify. Even the distribution of the base tax gap is super difficult to quantify in meaningful ways. And the nature of its concentration is hard to get a grapple on. So I take the point that there might very well be all kinds of evasion that I don't fully appreciate and aren't fully reflected in the sorts of statistics that I've given you. If anything, I think that means we need even more resources here and even more information on the ways in which these opaque income streams are accruing and to who, not less necessarily. The question, I think the other question was about evasion versus avoidance, which is a very good question. Both are really important problems to solve for. What evasion is literally illegally not paying the taxes that you owe under our current tax code. Avoidance, there is a ton of ways in which you sort of take advantage of loopholes in the code or do aggressive tax planning in order to try and, or take aggressive tax positions in order to try and lower your tax bill. That is a set of quite difficult challenges to solve for, and are often the line between evasion and avoidance is kind of blurry in ways that it's hard to disentangle and fully appreciate. But this proposal, it's almost, even before you get to, you certainly should do a lot of loophole closing, and I hope that we'll be able to do much of it over the course of this administration. But even before you get to the loopholes and even before you get to the tax planning, it's really quite striking that we let 15% of taxes that are owed just go uncollected each year. And it's quite striking that it comes so much from and what our distributional analysis tells us is it comes so much from the top. And I will say one thing about I know I said the sort of lobbying effort has been striking. Another piece that it's just worth pointing out is that in some ways it's been obviously hard to sort of push against a misinformation campaign that's been incredibly strong and incredibly well resourced. On the other hand, I am heartened by the efforts that are being made by those opposition groups, because I think they're a testament to how meaningful these changes will be once they are enacted. And I hope that all of you who are listening sort of are of that view also and watching all of this, because there really is so much here, both as a matter of revenue and as a matter of fairness. And it is really first order for this administration, and it's first order for my colleagues on the Hill who have spent a lot of time thinking about these proposals and drafting in this space as well.
I think that's a great attitude. It's somebody that constantly advocates for very unpopular stuff, especially among interest groups. Being able to be heartened by people opposing what you want to do, I think, is a great way of looking at the world. It certainly make me happier. There's a few questions here about, I think that, you mentioned that IRS has significantly reduced its workforce, but I think people have a memory of the old IRS being very heavy-handed, being sort of abusive in its tax collection power. You even kind of look back at 90s sitcoms, and right, that's a not uncommon theme. How do we, as we build back up the IRS have a kinder, gentler, less invasive IRS and auditing process?
I think there are three dimensions to how we sort of push back against what I've spent a lot of time with the IRS. I admire my colleagues at the IRS, and they are truly doing heroes work at a time in which they have experienced very significant resource strain. The ways in which they've been able to advance a CTC and get out EIPs to families that need them over the course of the last year is just remarkable. And so I hope that some of these successes and the ways in which they're being able to meaningfully touch every American family today are a testament to the kind of work that the IRS is committed to doing going forward. I think that the sort of kinder, gentler is an interesting phrase, but one I will take from you, which part of the reason why it is hard to, it's kind of ironic, but part of the reason why it is hard to advocate for kind of some of the investments and information to the IRS that I've been advocating for and that this administration is very focused on is because of a fundamental and totally understandable frustration with an agency that is able to answer less than 30% of the phone calls that it receives from American citizens. This is a space in which we know how poorly we are doing, and we know that it is about resources. And I firmly believe that investments in taxpayer services will improve not just taxpayer morale and improve tax compliance because your questions are answered, but will also improve the perception of the agency as one who is keen. And it's not that they're not keen to serve taxpayers the way they should be served presently. It's just that they haven't been given the tools that they need to be able to do so. And so I think that's a very important piece of this. I actually think the information reporting regime is also an incredibly important piece of this. Because in reality, when you invest in the IRS and you give it the information that it needs to be able to disentangle a taxpayer that is compliant from one that isn't, that means that the likelihood that a compliant taxpayer who's already doing everything that they should is going to be wrapped up in a costly and burdensome audit decreases. And so this experience of having the IRS be at your doorstep kind of auditing you, even though you've done all that you were supposed to do, right now that happens because when the IRS is making enforcement choices, it's shooting in the dark. It has no idea who might be compliant and who isn't. In a regime in which the IRS has better information, compliant taxpayers are going to experience a very significant benefit vis-a-vis their interactions with the agency because they're going to interact with them less because the IRS won't audit them and will focus its audit attention where it belongs, which is on tax sheets who are disproportionately at the top of the distribution.
We have time for a couple more questions. What I want to ask is we've spoken a lot about giving the IRS more money and about this information reporting, but what else can be done to reduce the tax gap? What are there lessons we've learned from other countries? Is there anything in the field of behavioral economics that we can increase voluntary compliance? What else can we do to get people paying their taxes? So
it's interesting, and this gives me a chance to talk about two pieces of about some of the revenue here and why I think it's both a space where a lot of good can be done right now and a lot of good can be done in the future. We have a $7 trillion tax gap. Maybe it's a $12 trillion tax cap left unaddressed over the course of the next decade. The proposals that the administration has put forth raise a lot of revenue. They raise $700 billion, but that's 10% of the tax gap. So there is a lot of space to do much more with respect to being able to collect the taxes that are owed presently than even these proposals are aspiring to do. That what you can learn from the experience both in this country and of other countries is that the best way to improve voluntary compliance and the best way to make significant progress on the tax gap is to have capacity for there to be viable information reporting regimes where there is a way for the IRS to have a lens into, and tax administrators generally to have a lens into verifying that taxpayers are appropriately making good on their obligations. And this is one very important information reporting regime proposal. There are others in other spaces that we should really think about in the trust space, for example, and in other dimensions where it's really important to think about the capacity of information sharing to be hugely impactful from a compliance perspective. I think the one thing I also want to stress is that if anything, these numbers that I've given you, this like $700 billion and the 1.6 trillion over a decade, they seem like very large numbers, and they are. That said, they're hugely conservative because they don't actually include a lot of the revenue that is going to be generated from the kinds of investments and the kind of information that we're going to provide to the IRS. Specifically, the nature of how this sort of, and it's a longer conversation about how this sort of scoring and how the revenue estimation works in this space, but the top line fact is that the dollars that are scoring here are enforcement dollars. That's about $55 billion of an $80 billion investment in the IRS. That means that the huge increase in compliance that will come from having tech systems that aren't 50 years old and from having real meaningful service investment isn't reflected at all in the revenue potential that I've sort of quoted to you. So I think even the proposals that we're considering presently have the capacity to do a lot more than they're even sort of accounted for officially. And I think that there's a lot more to do in this space, especially with respect to viable information reporting regimes that can make meaningful progress.
Thanks very much. I want to ask one more question. You got out of having to answer about the administration's secret trillionaire tax that I know is coming out next week. But at some point, Republicans are going to be in charge again. At some point, they're going to be in charge of the White House, of the Treasury, and of Congress. What can be done to make these kinds of tax gap changes durable? And how do you convince your Republican friends that when they take control, they should hold on to and build on them rather than reverse them?
Listen, I have two sort of points on these dimensions. One is I was struck, and I know you were struck also, Mark, by watching the bipartisan infrastructure deal unfold on a lot of dimensions, One thing I found really remarkable is that for a very long time, one of the most important offsets in that package was a very substantial investment in the IRS. A bipartisan group of senators, Rob Portman, is sort of speaking to the importance of investing in the IRS and the importance of, and speaking to the fact that the revenue estimates that exist in this space from official scorekeepers are hugely understated in ways that are important. I think that the world has shifted. It goes back to your first question. The world has shifted in meaningful ways with respect to the importance and the substantial potential of the kind of compliance initiatives that we're pursuing in this space. And so I mean, you might call me naive. I'm hopeful that these are going to be incredibly durable changes. And part of the reason why they're going to be hugely durable is when you think about what we're going to be doing here, like just from a resource perspective, you're giving the IRS the tools that it needs to rebuild and modernize. It's not like after modernizing and building up a workforce that is so sizable and capable of doing partnership audits and capable of doing global high net worth audits in ways that it's not presently, those are changes that can't really be rolled back. Once the IRS has those capacities, that will be the agency, and it will have been overhauled and brought into the 21st century in ways that will persist. And I think that there is a lot of I think there's a lot that we will have to do once this is legislated, and a lot that the IRS will have to do to really make the most of all of these changes and really deliver on what we've promised to the American people. But I'm pretty hopeful that this is a unique moment for tax compliance. And I'm kind of hopeful that there is actual bipartisan support for the types of efforts that we're looking to pursue here.
And just thank you so much. Just one anecdote I'll say is that we went back and looked at all President's tax gap measures, and going back to the first President Bush, there was talk about getting the IRS into the 21st century. So I'm hopeful we'll do it before it's actually time to move us into the 22nd century.
Fingers crossed. It's going to be a big few weeks, so we'll see.
Yeah. Thank you so much for joining us. This has been really helpful, and thanks everyone for tuning in. If you have more questions, feel free to shoot us an email. Check out our tax gap resources, check out Treasury's tax gap resources, and we'll see you all soon. Thank you.
Thank you all.